Singapore's largest lender, DBS, posted its second highest ever quarterly net profit thanks to higher interest rates. Its second quarter net profit rose 7% on year to 1.82 billion Sing dollars, beating analyst estimates. Net interest income grew 17% on year to 2.45 billion Sing dollars. Its net interest margin, a key gauge of profitability, rose by 13 basis points to 1.58%. It more than offset a 12% decline in fee income, with lower contributions from wealth management and investment banking. Non-interest income also fell 10% from lower investment gains. Expenses rose by 7% on higher staff costs amid a tight labour market. The bank announced a quarterly dividend of 36 cents per share. DBS CEO Piyush Gupta says the bank's loan asset quality remains resilient even with these higher rates.
So as long as rates stay within 3.5%, that has already been factored into our cash flow and affordability calculations when we gave the loan. So it's quite solid. Which is why if you look at the history of Singapore mortgages, they never impacted too much by interest rates. They generally impacted more by unemployment. If there is no job, then you have a problem. So I think the thing to watch is if you have a massive spike in unemployment, then we'd go and worry about the delinquencies in that portfolio.
All three local lenders ended higher in today's trade. They've wrapped up the earnings season with larger profits as rising rates push their net interest margins higher. Heidi tells us more.
A strong second quarter for Singapore banks, with rising global rates translating into higher net profits. OCBC outperformed its peers. Its net profit increased by 28% thanks to robust performances across its banking, wealth management and insurance businesses. Net interest margin, a key profitability ratio for lenders, continued its upward climb in the last quarter, and analysts are optimistic that the growth will continue.
The quarter-on-quarter NIM expansion, this should be a bit more substantial in third to fourth quarter of this year and perhaps start coming off in the first half next year.
Overall, we do still expect the bottom line for the Singapore bank to be slightly higher for full year this year as compared to last year.
Weaker market sentiment has seen income fees drop in the bank's wealth management and trading segments, but analysts point out that they've been cushioned by higher net interest incomes. All three banks also say they do not expect a recession, but rather what's called a soft landing instead.
That implies, a more tempered inflation, a mild recession, and a contained flow through to Asia. But definitely, given the current uncertainties, we cannot rule out tail risk of a sharper slowdown and a sharper flow through to Asia, as well as a more stubborn inflation, as well as a sharper currency depreciation in Asia.
DBS has declared a dividend of 36 cents per share for the second quarter, OCBC an interim dividend of 28 cents per share, and OUB 60 cents per share.